I'm going to focus on two principles. One is the cause and effect principle, and the second one is effort versus results principle. We will try to find it on the daily chart first, that is the long term chart, and then drill down to the shorter term chart, maybe using market profile and VSA on a 3-minute chart. First, let us start with the cause and effect principle. Okay, so what is the cause and what is the effect when we are dealing with markets? So we all know that when the market is trending like this, okay, this is a nice trend, it goes on for few months, and you can also see that there are some shorter term trends which are going on for a few days to maybe couple of weeks. Then there are some very sharp falls like this. Okay, so all these times when the prices moved sharply, these are the effects. All right, these are the effects. So we want to, let's say, buy low and sell high every time, or sometimes we want to sell high and buy low, because that is how the smart money makes their money. They buy low and they sell high. So if you want to do that, you need to know when a particular effect is going to start, right? When a particular trending move is going to start. And are there any signs which will tell us that yes, that move is slowing down, that move might be closer to finishing, and you should be looking for an exit? Okay, so to catch this effect, first we need to understand what causes that effect, all right, or how this cause looks on the chart. So next time whenever there is a cause developing, instead of ignoring the market, saying that the market is not trending and there are no opportunities in the markets, you will in fact be closely tuned in. All right, you will be in fact more excited, because now you know that the next thing that is going to come in is the effect. But for that you need to identify the cause correctly. What happens when a cause is happening? All right, a cause is developing on the charts. So we all know that when the smart money finishes accumulation, a trend starts. When the smart money finishes distribution, a downtrend starts. Accumulation will be followed by uptrend, distribution will be followed by a downtrend. So basically, whenever there is a cause developing on the markets, there will be one of the two things happening. Either the smart money will be accumulating or they will be distributing. Fine. Now we know that whenever there is a cause developing, smart money is either accumulating or distributing, and it will be followed by a nice directional move. The next question that you should ask is, all right, how do you identify whether an accumulation or distribution is going on? Now, if the smart money wants to accumulate stocks, do you think they will buy every breakout? All right, you see that market breaks out here, they buy, market breaks out again, they buy, market again breaks out here, they buy, again there is a pullback and a breakout and then buy. Or this whole trend was lots of swing highs followed by breakouts, starting with this breakout. Do you think smart money is buying whenever there is a breakout? See, whenever there is a breakout, the market moves quickly because the liquidity is low. Make sense? So here in this particular case, market moves sideways and then the sellers, they dry up, the selling is absorbed by the buyers, and when there are no more sellers, the liquidity dries up, nobody is selling here. And if nobody is selling here, where do you think market will go? Market will increase in value, that is the price will increase, so that new sellers are attracted. Again same thing, sellers absorb, market will increase in value, again to uncover where the sellers are there, sellers will be attracted to higher prices. Make sense? So What we want to find out are the areas where we have liquidity, where traders can trade freely. Freely by this I mean, if they want to buy, they should be able to buy. If they want to sell, they should be able to sell without moving the price too much. Smart money is buying, or you want to buy and you wait for a breakout. As soon as the breakout happens, you say, oh my god, the price has gone a little bit higher, I'll wait for a while, I'll do it tomorrow. The market again gaps up, you again wait for a while, market just keeps going on, and either you end up chasing the price or you don't take the trade at all. Why? Because it is not easy for you to buy when there is a strong breakout or a strong uptrend. So when can you easily buy? Either when the market is going down or the market is moving sideways. Now, you and me are retail traders. Maybe we are buying 1 lot, maybe 5 lot, 50, 100, 500. But at some point in time, our capacity will run out. We will not be able to, let's say, come and say one day that yes, I am going to buy 50,000 lots. That is not what we can do as retail traders. But the big traders, the smart money, the institutional traders, they have reasons to buy these quantities. Either they want to or they have to. Maybe they are hedging something, maybe they have positions in other stocks and they are using index to hedge those positions, so they have to do this. So they will need periods of liquidity where they can buy freely, where there are other traders who are selling freely without moving the price. All right, the price does not move much. Now, for this to happen, the smart money has to trade in smaller quantities but more frequently. All right, so they won't be buying. If they have to, let's say, execute a 50,000 lot position, they are not going to come in and say put 2 orders of 25,000 each. No, they will break it further down, maybe as low as 100, 200 lots, and they will keep buying here and there within a range slowly till they accumulate their whole position. Now, there is not just one smart money. Okay, smart money is a group of traders. There are many institutional traders, there are many HNI traders. Okay, there are many FII traders. Everyone has their own opinion about the market, and if they all believe that yes, market is going to go up, everyone cannot just come in and buy all at once. That will just push the market up in a straight line and no one will benefit from the move. So what they do is they need sideways move to happen, and to make sure that this sideways move continues, they will trade in smaller quantities for a longer time. This is where your time correction or this concept comes in. Who needs time? Smart money needs time. Smart money needs 2 things to establish their position. 1, volumes. 2, time. Now, we all have been spoilt by that vertical volume. All right, you see a big trend day, a big breakout day, the volume is too high, and you start to believe that okay, all the smart money is entering on this day, and all the other days when the volume was low and the market was moving sideways, they were just absent. No, that is not true. In fact, they were buying all along in this sideways move, and as soon as the supply is completely absorbed, that is when the breakout happens. So what we need is areas that give smart money time as well as volume to establish their positions, and these areas will look like consolidations, all right, on the chart. So next time you see a consolidation happening on the chart, maybe it is sloping down, maybe it is moving sideways, like this, or it is a little bit volatile like this, you should understand that smart money is up to something. Smart money is trying to do something. Okay, now whether smart money is buying or selling, that only unfortunately is clear from the follow through. Or if you have some common sense, you can easily determine it. You can see that the market is in a very strong uptrend here. Okay, market is making higher lows. See, market is continuously making higher lows. Market is moving higher. If market is making higher lows, then the uptrend is intact. And if in an uptrend, a strong uptrend, you see some sideways move developing, what do you think the SM is more likely to do? They are more likely to accumulate or reaccumulate. Make sense? If the market breaks down and you see markets moving sideways for a while, there is a higher chance that SM is distributing or redistributing. So you have to use very simple assessment of the markets. All right. Don't try to get too many indicators, too many different methods together. Now you might be seeing that Dean, you're talking about simple charts, but there are so many signals here. Well, if you know how to interpret those signals, you will not be distracted by them. Make sense? So these signals are there, but they are there only to help you when it is decision time. Okay, but before you can decide whether you are going to buy or sell, you have to develop a trade. You have to understand how the market is developing, what it is trying to do, whether it is an uptrend or not, whether we are moving sideways in a consolidation or not. Are we around an important resistance or support? How the traders are expected to react. Now, just give me an answer. This is one of the resistances. Now, just for the time being, ignore all this follow through, because once you look at the follow through, you cannot unsee it. But still, we are just trying to do an exercise here. Okay, I want you to give me answers quickly. This is a resistance. Why? Because the market was in a nice uptrend, and this green line is actually 200-day moving average. So many people use that. Now we have moved above that. This red line is the 20-day moving average, and it has also crossed the 200-day moving average. All the traditional trend indicators are telling you that we are in an uptrend, and then market moves sideways. It moves sideways and then it again swings up and comes to this resistance level. Make sense? What is the expected behavior here from the traders? If you reach a resistance, they are what? Expected to sell. Now you tell me whether this is correct or not. If you believe this is correct, type yes. If you believe this is not correct, type no. If someone types no, then I have to investigate and answer his doubt first. So you guys can start typing yes so that I can move on with the presentation. And if you believe it is not correct, then type in no. Alright. Ramnivas says yes or no. If anyone has, Satish says yes. Purushottam, Prabhu, Narendra. So many people are saying yes, so I will, no one has said no yet, so I will say that, okay, you believe that if there is a resistance and market comes there, obviously the expected behavior is that selling should come in. Now, if selling comes in, where do you think the market should go? It should go down, right? So there is a resistance, market goes there, selling comes in, market should go down. What if the market, instead of going down, moves sideways? What if instead of going down, the market moves sideways? What it tells us is that yes, this is a resistance. Yes, there was a lot of sideways action. So here the smart money was active. That is your first observation here. That yes, we are moving sideways for a couple of months. Smart money is up to something. Either it is going to go up sharply or go down sharply. Now, how do you determine whether they were buying or selling? Okay, if they were selling and the trend was going to reverse, then very simple trend indicators like a 20-day moving average going below 200 or we crossing below 200-day moving average should happen. We do not do that. Now, if you are trading with me for a long time, then you know we talk about last points of demand. Now, this HVN is a clear last point of demand because after that we moved higher and moved sideways, created value. What is happening here? We come to the last point of demand and buying comes in. This is a support area. Buying should come in. This is expected behavior happening. Good. What do we know? Buyers are still in the game. Now we come to the resistance, we expect selling to come in, we expect the prices to go down. Instead of going down, prices move sideways. What it tells me? That yes, selling is coming in because market has stopped going up, but the buyers, they now are committed to a breakout and they are buying every small selling attempt. And what is the result? The result is a big up move. So we have both the principles playing here. We have first a cause developing. You can see we start here. This big rectangle shows me market moving sideways, smart money doing something. I don't know whether they are accumulating or distributing. I am confused, so I wait for some more time. I see prices going lower. Suddenly I'm excited. Okay, this is a top. Market is going, suddenly you'll see on Twitter, market is going to 7,500. Market is finished now. But where does it stop? It stops at the last point of demand. Okay, if you are an auction theory student, you have ever heard my me speaking, or if you have ever gone through my videos, or maybe you have gone through my courses, last point of demand, if it is not taken out, the trend is still in place. Market bounces back, buyers come in. So what is happening? This cause is developing, but within this cause we are also getting signs that yes, buyers are making an effort. When the prices are coming down, they are making an effort to defend the last point of demand. Market continues higher. It comes to an area where supply is expected to come. Supply comes in, market stops going higher. Buyers again defend, again put in a lot of effort to stop the market from falling. And now it is their time to enjoy the result, because now the trend has started. Now when this breakout happens, everyone will start talking about Indian story is good, fundamentally everything is fine, economy is strong, demand is strong, and all those explanations will come in, and everyone will start buying stocks, mutual funds, and the market will keep going up and up. So first, the cause was developed. This result is the effect. During the cause, if you want to find out what is likely to happen, a breakout or a breakdown, you have to monitor smart money activity at key points, key trade locations, not anywhere. You have to identify what the buyers are doing at key locations. So here, the last point of demand is a key location. Buyers come in and defend. First sign that yes, the trend is strong, buyers are still there. Aggressive traders can simply go ahead and buy. In fact, anyone who is trading with me, if they see last point of demand defending and they buy, I'm not going to say anything, because that is the correct way to do it. So you buy here, let's say directly. You see last point of demand getting defended, you jump in. You say, I am an aggressive trader. I want to keep my risk small. I don't want to take too much of risk. I want my stop losses to be small. There is a 200-day moving average. There is a last point of demand. I'm not waiting. I'm buying. Okay, you buy, and what you are getting, you are immediately rewarded with a nice up move. This is a big up move. Then you see markets stop making new highs. What do? Now you know, okay, there is a resistance. Supply is likely to come. You can book your profits. Or if you are a long-term, trader, you can start selling calls, or you can basically start hedging your position if you just want to continue with it. Anyways, market goes sideways. First attempt to move down fails. Second attempt to move down fails. What is this telling you? That no, buyers are still putting in the effort. And if you still hold your position, now you know that, okay, this is the correct position. You may still continue with the hedge till a clear breakout happens, but now you know that yes, you are right, you have caught a great trade, and then this happens. This is the result of all the efforts the buyers or the smart money buyers have put in by defending here, and this is the result you get. Makes sense? Now, this particular cause and effect and effort and result principle will keep on happening in the markets all the time. And if you want to find out where that is going to happen next, what do you think you have to look for on the charts? You have to look for sideways development. Sideways development. You have to look for consolidations. Please forgive my handwriting and my spellings, because when I'm speaking, my hands are not fast enough to match with where my mind is going. I hope you get the point. All right. Again, let us verify this. Let us verify quickly. Market is moving higher. Market is making, higher value areas. 220 moving average, simple system. I'm not encouraging you to use that, but a simple system is telling us that the trend is strong. This is the last point of demand. Then we move higher, we get some selling and market comes down. When the market is coming down, what do we have to look for? Last point of demand. Whether we are stopping at the last point of demands or not. When the trend is strong, the last point of demand will keep on moving higher. Market stops at the last point of demand. You get a big bar up. Anywhere on this day you bought, you made good money after that. All right. Okay. Market first holds the last point of demand. What do you now know? Smart money buyers, they are putting in the effort. Good. This is a positive sign. But then market goes into an extended correction. And this correction is not sideways. It is overlapping to down. That is all right. See, market, nobody is going to control the market. If market wants to develop a correction which is overlapping to down, when the value areas develop, you can see this value area is slightly lower. This is even slightly lower. This has a downward slope, but it has a lot of overlapping. So market is going to do that. Market is going to do that. How long are you going to hold on to your positions? Or when are you going to decide whether the trend has changed or not? You don't try to catch the tops. That is the amateur way of trading. You look at the last points of demand. Now, if I extend this last point of demand, we don't even come close to that. Don't even come close to that. Right? Okay. Then what happens? There is this down sloping trend line. When we come to that trend line this time, do you see prices getting rejected? On all these previous occasions, when prices go to the upper trend line, we get rejected. We go here, we get rejected. We go here, no, we are not getting rejected. We make a low, higher low. We make a higher low. We do not break down. And then we again make a very small consolidation. Again a higher low. And finally the breakout happens. Now, these are subtle signs. These you should learn to observe. These will be different in different situations. So instead of asking, Dean, what is the pattern? What is the setup? What do I have to observe exactly? What geometrical shape should form on the charts? Which support or resistance should be respected? No, don't ask me all those questions. What you should ask me is, Dean, what behavior should I see on the charts? Higher highs, higher lows is a bullish behavior, right? Not taking out last points of demand, bullish behavior. Prices coming to last point of demand, getting rejected strongly. Smart money buyers are putting in the effort. It's a strongly bullish behavior. And when you come to a resistance, prices not getting rejected back, again a bullish behavior. Now, when all this consolidation and correction is happening at key points, what are the key points? Last point of demand, resistance, previous swing highs. This is a previous swing high. The previous swing high was here. Then the previous swing high was here. When you come to the previous swing high, you get a bullish behavior. If you get bullish behavior, you find every reason to buy. You can buy breakouts, you can buy pullbacks, you can do whatever you want. Any setup, any method, any indicator you come and you apply, if the behavior is bullish, if all the important decision points are respected, you will see higher prices. Prices go higher, you make good money. Again, another example. Let me just clear all that. Here, what is happening? Lot of sideways movement. This was the previous swing high, or I think it was the all-time high at that time. And then we come here and instead of moving higher, we move sideways. Yes, when you come to a swing high, resistance, supply is expected, it comes in. market moves sideways now, just with our current discussion, I believe you should be able to tell me that, Dean, this is a cause developing. Market in a tight range, market not giving up ground, market not taking out last points of demand. All the bullish behavior is there and market is moving sideways. Smart money believes prices are going to go much higher. They want to accumulate. So they will create some supply, they will create some indecision. Traders will stop committing. Who are the traders who will stop committing? Retail traders like you and me. You buy somewhere here, market goes down, it hits your stop loss. You again buy it, again hits your stop loss. You again buy, again hits your stop loss. Retail traders' confidence is broken. Now, either you are out of the market, or because 3 times your stop loss was hit, you are now short the market. You somehow believe this is the top. And when these things are happening, go and find the news channels. This time, don't watch it on mute. Increase the volume. Observe what your favorite analysts are telling you. I will bet my bottom dollar that they will be talking about bearish things. They will be talking about potential tops. They will give you bad news. They will talk about why the economy is struggling, why the RBI has to increase the rates, why a particular company's results are not good. Why is all this happening? Because if there is bad news surrounding the markets, retail traders sell. They will put redemptions on their mutual funds. They will exit their mutual funds, their stock holdings, out of fear that market may turn and market may come down. And who is taking the other side? Because if you guys are selling and market is not coming down, who the hell is buying here? The buying is done by smart money. So forget about price, forget about patterns, forget about geometrical shapes, everything. Focus on behavior. If you feel afraid, you feel like selling and you get out of your position, but market refuses to come down, you should be alerted that something is not correct. You are not reading the markets correctly. What happens afterwards? Just see. Market goes, how many points is there? 16,000 to 18,000, 2,000 points in a matter of couple of months. And before that couple of months, we were moving sideways. In fact, I would say that from this point onwards till this point, all right? So that is what? This is January, February, March, April, May, June, July, and the breakout actually starts somewhere in the August. So 6 months, bloody half the year, market moves sideways. There were trades in between. There was this trade, you could have shorted in this correction, and when the market was moving down, all those things are good, and you can do that. But if your view is longer term, then you had to just stay inside the markets. Now, this is very good, Dean. This works on higher time frame. We are happy. Can you show us examples of this on shorter time frames? Let us find out. Let us see if we see prices creating causes, prices giving effects, prices where or areas where you can see that buyers and sellers are putting in a lot of effort and then they are getting rewarded for it. Let us try and find out. Let me see. First, let us look at the current market. What is happening right now? Okay, pardon my slow computer, right? The computer is as old as I am, all right? Okay, fine. So what do you see in this particular market behavior? A lot of traders are surprised by why the market fell very, very sharply, okay? And now they are equally confused whether it is going to continue lower or higher. Look at this whole behavior, all right? Can we mark some sideways consolidation areas? Let us see if this is a sideways consolidation, if this is a sideways consolidation, if this small one is a sideways consolidation, okay, if this tight range is a sideways consolidation, if this big range is a sideways consolidation, even this is a sideways consolidation, all right? What is followed after the sideways consolidations? First, the market was moving down, a sideways consolidation happens. First you get a reversal. Then market creates a higher low. Okay. All these sideways consolidations. What is happening? Okay. What is happening? Whenever there is a sideways consolidation, what do we know? Market is building a cause. When market is building a cause, who is active? Smart money is active. If smart money is active, what do we want to see? What is the smart money behavior? Is it bearish or is it bullish? Extremely simple. 3 steps. Market moving sideways or not? Yes, it is developing a cause. Whenever the market is developing a cause, who's active? Smart money is active. If the smart money is active, what is the behavior? Bearish or bullish? Can you ask these simple questions when you come to the market next time? Please give me a yes if you can. Can you ask these 3 questions? Write it down. Obviously, you are getting this recording again. You can watch it again. 3 questions. Whether the market is moving in a sideways consolidation. Yes. Okay. Let us look at the latest price action. Okay. Is it moving sideways? Yes. The highs are clustered. The lows are clustered. Yes, it is moving in a sideways consolidation. Nice. So what do we know? Market is building a cause. Fine. When the market is building the cause, this is a fact. You don't have to ask the question. That is a straight away answer for you. When market is building a cause, smart money is active. This is a fact of the world. This is a real thing. Okay. Now comes an interesting question where you will need some experience. Okay. Or you will need some material that will guide you in proper direction in identifying whether the behavior is bearish or bullish. Simple 3-step process. Now, how will we determine whether the behavior here is bearish or bullish? Okay. For this, I think I'll have to take help of market profile chart just to show you the composite HVNs. Okay. So August 18th onwards, we are going to analyze the markets. Okay. This is August 18th. What do we have? Sideways days, couple of days. Let me merge those days. Okay, fine. This is nothing kind of a day, completely overlapping this day. So usually I would not merge it because this day does not have a nice, shape to it, a normal distribution shape to it. But to make my point, I'm doing this, all right? This is not advised. Okay, whenever you merge too many profiles, obviously you are going to get a nice normal distribution curve. Fine. So when the market was going down, you can see normal distributions happening, prominent point of controls happening, poor lows left behind. Market is exhausting. Since it is going down, sellers are exhausting. Okay, we go back up. Let me split this. It is essential for us to know. Okay. Now, what we have to identify is on these 2 days, August 24th and August 25th, whether the behavior was bullish or bearish. Okay. August 24th, market opens strongly higher. Behavior is bullish. The start is bullish. Okay. Start is bullish, fine. What do we expect after that? Market should keep extending the range. Market should give you range extensions. One time framing to the upside. Market should develop a nice wide price range. Market should cover a lot of price. Is it happening? We open, we go up, B period makes 1 tick range extension and the market stops. Buyers are strong, sellers are exhausted. Why buyers are not able to keep pushing the markets up? This is a big question. Is this behavior bullish? I don't think this is bullish. If it was bullish, you should have seen a nice trend. Market opens gap up, lot of sellers are trapped. You should see higher prices. You are not seeing higher prices after the open. Okay, fine. If market is not doing a good job of going higher, if this behavior is not bullish, are we seeing any bearish behavior? Okay, let us see. C period extends the range below the B. D extends the range. E is an inside bar. F extends the range. G is an inside bar. H, I, K, L, M all are extending the range to the downside. After D period, we extend the range below the initial balance low even. If you ignore A period and just look at B period as the start of the day, does this look like a trend day to the downside? Have we covered a lot of price? Yes, bearish behavior to the downside. Are we extending the range? Yes, bearish behavior to the downside. Is it one time framing? Yes, bearish behavior to the downside. So our first question is answered. Is the behavior bearish or bullish? It is decidedly bearish. Okay, fine. You get one bearish day, it does not make all the difference. What is the follow through? Okay. Next day opens lower, gaps down. Bullish or bearish? Bearish. Market goes lower, extends the range below initial balance. Bearish. Some pullback happens. Market gets resisted, comes back down. Bearish. Another pullback, market is making lower lows. Bearish. Lower highs here. Bearish. Do we make a lower low now? By the time we close, we make a lower low. Where is the market closing? This is all the trading market has done. Okay. And we close below that. Anyone who bought here, are they making profits or loss by this close? Their position is underwater. They buy at 350, 340, 320, 300, 250. Market closes here, 223. All these buyers, they are losing money. They are not happy. If they haven't covered their position, they are anxious when they will come back tomorrow for trading. That is on Monday. So all this thing, when you look at it, do you think this is bullish or bearish? Okay, let us come here. Let us look at a very simple indicator, VWAP. Okay, we start higher, we are above the VWAP, but after this breakdown, we continuously stay below the VWAP. Here, even though there are multiple lower highs and then we break below the low, twice we have created a lower low, never we created a higher high. All this is bearish. Alright. Now, if we have lots of causes, alright, we have lots of causes. This particular cause gave us this bullish follow through, but after that, you have tons of causes. Market is going higher, alright, but this follow through tells me that all these causes were used by smart money to sell. This is obviously happening after the follow through. If this day, instead of going lower, developed higher, then I would have concluded no, smart money was not selling, it was buying because of the positive follow through. But here, price wise, any trader who is just looking at price, he will be happy with this higher open. If he has bought on any of these occasions, he will be very, very happy. He will be overconfident and he will only look for supports in this market. He will say, okay, this H1 will hold, this H1 will hold, this VWAP will hold, this swing low will hold. Nothing is going to hold because the behavior is decidedly bearish. If there was all this buying happening, why the behavior was bearish? Why we got a confirmation? Why we are making lower highs and lower lows? Not a single attempt to make a higher high. Why we are closing below VWAP? Why cumulative delta here, another wonderful indicator, is negative whole day? Why when this behavior turned bearish, the cumulative delta made a crossover? Why all this is happening? All this is happening because all these causes were used by the smart money to establish short positions. And now when I tell you all this, what is the follow through that you expect from this point? Do you believe market is going to go up or down? I believe the market is going to go down. So do I have a short position? Not yet. But if market opens lower on Monday and it starts creating lower value area, I will be concluding that the behavior is bearish. And what do you do when the behavior is bearish? You just add two letters after that. Credit spread. Bearish, credit spread. Simple. Behavior is bearish, you add just credit spread. What will I do? I will find a nice call option beyond an important resistance point, gap resistance, some HVNs on this day, VWAP resistance, all-time high resistance. I will find a good call option which is beyond this resistance and I will sell it. Then I will buy a higher call option to hedge it, and in turn I will have what? A bearish credit spread. Now Let's say I sell 19,600 call or 19,500 call, and if the market stays below this call on Thursday on expiry, I will be making all the credit that I have received. Not the don't have to deal with this short term volatility. What if market opens higher, goes up, tags the IB high, now you are worried whether your position is correct or not? No, we are far away from the market, we don't have to worry yet. What is the resistance that we are looking at? Gap. What is the resistance we are looking at? VWAP. What is the resistance we are looking at? High of this day. We have just broken above the IB high. Market will go here, trap all the eager buyers. All the scared sellers will be pushed out of the market, and market will go down because the behavior is bearish. So staying close to the current market price can give you heart attacks, can give you headaches. Staying away from the current market price, a peaceful way to trade. What do you want to do? Do you want peace in your life, or do you want stress in your life? Make sense? So this is what I wanted to share with you. Cause and effect, effort versus result. Okay, lot of effort. If you say, Dean, no, VWAP is moving up on these 2 days, we are making double bottoms, we are making higher lows here, this whole behavior looks bullish to me. Excuse me. And if I don't have all this follow through, and you come to me and you say, Dean, this is bullish, I will say, yes, absolutely, this is bullish. We are taking out lower trending VWAPs, we are making higher value areas, we are making higher lows. Yes, this is bullish behavior. Lot of effort is put in by the buyers. Good. Now when it comes the time to get the result, because you have put in all this effort, you should get some result. What are the two principles we are studying today? Cause and effect, effort versus result. You should be expecting good results. You get a strong opening, and after that for 2 days the behavior is bearish. Is it a good result? Buyer studied so hard. Let's say you are one of those person who believe in studying. Buyer studied so hard, they worked so hard day and night. Is this result good? No, they have failed. The result is bad. They are not getting into a good college. The result is absolutely bad. So buyers putting in a lot of effort, result bad. That tells me that who was buying here? Retail. Who was buying here? Amateur traders. Who was selling here? Smart money. They got their higher prices, they got short at higher prices, they have slowly accumulated huge short positions. Now when the market breaks down, let's say it breaks down on Monday, it is going to create a lot of problems because it will move down sharply. Okay. If it does not go down, if it simply opens sideways, little higher open and then just continues to move sideways, if it does this, what is this? Sideways development. What I have asked you, if it is a sideways development, what is it developing? A cause. If it is developing a cause, who's active? Smart money. If smart money is active, is the behavior bearish or bullish? How do you identify a bearish or bullish behavior? If we are not making highs above this, if you are not breaking this consolidation, if you are staying within the consolidation, preceding price action is bearish, value area formation is higher, and then we are continuing to develop sideways value but below previous value area. If we slowly keep breaking these lows, or if instead of moving completely sideways, let's say we develop overlapping to lower value area, what is the behavior? Bearish. If we develop overlapping to higher value area, there is some question mark. But I am not going to conclude immediately that okay, this is a bullish behavior, because there is a gap, there is a HVN here, there is a VWAP here. All these important key points need to be taken out. If market moves sideways here and then goes lower, gap is a key point. At key point selling came in. If it goes a little higher, tests this HVN and then goes lower, then yes, the pullback was a little deeper, but still the bearish behavior continues. So you now have a lot of references. now you have a new cause developing. And if we develop a sideways cause and we take out all these references, now what I know, the behavior is bullish. And if the behavior is bullish, what am I going to do? Credit spread. I am going to use a bullish credit spread. Simple. Instead of selling a call option, I will go lower. I will find a nice put option away from the markets, and I'll put multiple supports between that, and I'll sell nice put option and I'll hold my position. Obviously, I will not sell naked options. I will hedge it with a long put option and I will create a credit spread. Does this make sense so far? Do you think this is helpful? Give me a quick yes if you believe that this was helpful. Sadish is saying yes, absolutely. Okay, thank you for confirmation. Yeah, lots of yeses. Ramya is saying yes, Anvay is saying yes, Amod is saying yes, Prabhu is saying yes. Thank you guys. So this is what I wanted to share with you. Two simple principles: cause and effect, effort versus result. Apply them, give the market to confirm your observations, and then jump into positions. All right, stay close to the current market price, get headaches and high blood pressure. Stay away from the current market price and you will be peaceful.